Welcome to the Deep Dive, where we take complex topics and really try to make them clear and hopefully fascinating for you.
And today, we're looking at a real giant.
We are JPMorgan Chase & Co., a financial titan.
Absolutely. A name you probably see, well, everywhere. Banking, investments, certainly in the news.
Exactly. And we're not just, scratching the surface here. We've got their first quarter 2025 earnings report.
Right, the official press release.
Yeah, the press release, their earnings presentation deck, and even the transcript from the analyst call.
Ah, the call transcript. That's where you sometimes get the really interesting bits, the questions behind the numbers.
Totally. So our mission, if you will, is to really pull out the key takeaways from all this, what drove the numbers, any surprises.
And importantly, what does it all mean for you, someone who's trying to understand, the bigger financial picture?
Think of it as your inside guide. The press release gives the official results.
The presentation summarizes it visually.
And that analyst call. That's where we hear the tougher questions and maybe the less polished answers.
Okay, let's get into it. Where we start, the big numbers.
Yeah, let's start with the headline figures. What jumped out?
Well, first off, net income. Reported at $14.6 billion for the quarter.
$14.6 billion. And per share, that was
$5.07 per share.
Okay, $5.07. Now, how does that stack up against what analysts were expecting? We looked at the Zacks consensus data.
They actually beat expectations quite comfortably. Revenue was $45.3 billion.
Right.
The estimate was closer to $43.23 billion. So that's a beat of nearly 5%.
Almost 5% higher on revenue. And the earnings per share, that $5.07.
Even better there. The consensus estimate was $4.62.
So $5.07 versus $4.62. That's, wow, almost a 10% beat. Pretty significant surprise.
Definitely raised some eyebrows. It shows strong underlying performance relative to what the market anticipated.
Okay, so strong earnings. Let's talk profitability. The return metrics like ROE.
Yeah, return on equity, ROE, came in at 18%.
18%, solid.
And the return on tangible common equity, ROTCE, which excludes certain intangible assets, that was even higher at 21%.
So maybe break that down just a bit. What does an 18% ROE or 21% ROTCE actually signal to, someone listening?
It basically signals how effectively they're using shareholders' money to generate profit. 18 cents of profit for every dollar of shareholder equity is, well, pretty efficient. And the ROTCE being higher often gives an even clearer view of the core operational profitability, stripping out things like goodwill. Both are strong numbers.
Strong profitability, but for a bank this size, stability is crucial, right? Capital strength.
Absolutely paramount. And they look very strong there, too. Their CET1 capital ratio. That's the Common Equity Tier 1 ratio.
The key measure of loss absorption.
Exactly. It's 15.4% under the standardized approach and 15.5% under the advanced approach.
And just for context, those percentages, why should we care?
Think of it as their core safety buffer. The higher the percentage, the more losses they can absorb in a crisis without, failing. These numbers are well above the minimums required by regulators.
That's a really big cushion.
A very big cushion.
Yeah.
The press release also mentioned $558 billion in total loss-absorbing capacity.
Wow.
And a massive $1.5 trillion in cash and marketable securities readily available.
1.5 trillion. That's hard to even picture. It really sounds like that fortress balance sheet they always talk about.
It does. They're clearly prioritizing resilience.
So with all this capital, what are they actually doing with it? Is it just sitting there?
Not entirely. A good chunk is going back to shareholders. They paid out $3.9 billion in common dividends in the quarter.
Okay, dividends. That was $1.40 per share, I think.
That's right. And on top of that, they bought back $7.1 billion of their own stock, net repurchases.
$7.1 billion in buybacks. So quite a bit of capital return.
Yeah, if you look at the last 12 months, the release said their net payout dividends plus buybacks was 62% of their earnings.
62%. That signals quite a bit of confidence for management, doesn't it, in their future earnings?
It usually does, yes. Returning that much capital suggests they feel good about their capital levels and ongoing profitability.
Okay, but it can't all be rosy. What about the flip side? Credit costs. Any signs of stress?
There are some things to watch there. They reported $3.3 billion in total provision for credit losses.
$3.3 billion, and what does that consist of?
Well, it includes $2.3 billion in actual net charge-offs loans they had to write off.
Okay, loans gone bad.
Essentially, yes. And importantly, it also included a $973 million increase in their loan loss reserves.
Ah, so they're putting more money aside for potential future losses. Nearly $1 billion more.
Exactly. That reserve build suggests they're being cautious, perhaps anticipating some potential weakening ahead, maybe reflecting some of the economic turbulence Jamie Dimon talks about.
Right, that turbulence theme. We'll come back to that. So rising charge-offs and building reserves indicate some caution.
Definitely. Especially when we look at where some of those charge-offs are coming from, which we'll see in the segments.
Okay, perfect segue. Let's dive into those segments, starting with the biggest one for most people, consumer and community banking, CCB. How did that part of the business do?
CCB showed a bit of a mixed picture. Net income was actually down 8% compared to last year, landing at $4.4 billion.
Income down 8%. Okay, but what about revenue?
Revenue was up. It rose 4% year over year to $18.3 billion.
Interesting. So more money coming in the door, but less profit dropping to the bottom line in consumer banking. What explains that difference?
Well, the revenue growth was largely thanks to their card services and auto lending businesses. According to the Zacks data we have, that area saw revenue jump about 11.5% year over year. Pretty strong.
11.5% from cards and auto? Makes sense. People are still spending.
Right. But offsetting that, their core banking and wealth management side faced some headwinds.
Like what?
Lower deposit balances compared to the prior year, and something called deposit margin compression.
Deposit margin compression. We hear that term a lot. Can you quickly unpack that? What does it mean for, say, my savings account?
Sure. It basically means the bank's profit margin on your deposit is shrinking. The difference between the interest they earn by lending out your money and the interest they pay you is getting smaller.
Ah, okay.
So when their funding costs go up, or when the rates they earn on loans don't keep pace, that margin gets squeezed. And yes, ultimately that pressure can sometimes contribute to banks offering lower rates on savings accounts as they try to protect their own profitability.
Got it. So pressure on the deposit side. Any other key trends in CCB? Digital usage, maybe?
Yeah, they continue to see really strong growth in digital engagement. Active mobile customers were up 8% from last year.
8% growth in mobile users. Still climbing.
And debit and credit card sales volume, just the sheer amount people spent using their cards, rose 7%. So customers are definitely active.
Activity is good. But connecting back to credit costs, what was the charge-off situation specifically in cards?
The card services net charge-off rate was 3.58%.
3.58%. So that's where a chunk of those overall charge-offs are likely coming from.
Precisely. Consumer credit, especially cards, is often where you see the first signs of stress if the economy softens.
Makes sense. Okay, let's pivot now to the other huge part of the bank, the Commercial and Investment Bank, CIB. This is the Wall Street side, right? Deals, trading.
That's the one. And CIB had a very strong quarter. Net income was up 5% year over year to $6.9 billion.
Income up 5%. And revenue?
Revenue saw a really solid jump, up 12% to $19.7 billion.
Wow, up 12% in CIB. That's quite different from the consumer side's 4% growth. What drove that?
A big driver was investment banking fees. They were up 12% compared to Q1 last year.
Investment banking. So that's advising on mergers, helping companies issue stock or bonds.
Exactly. They saw strength, particularly in debt underwriting, helping companies issue bonds and advisory fees, likely from M&A activity picking up a bit.
Interesting. Did they mention the overall deal environment?
Yeah.
Because we hear mixed things about M&A.
They did. Jamie Dimon actually noted this strength came despite what he called increased client caution due to all the geopolitical uncertainty and trade tensions out there.
So companies are cautious, but they're still doing deals, or at least enough to boost JPM's fees significantly.
It seems so. The pipeline might have been building and some deals got done.
What about the trading side, the markets division within CIB?
Markets had an exceptionally strong quarter. Overall, markets revenue was up 21% year over year.
21%. What areas specifically?
Equity markets trading was the real standout. Revenue there surged an incredible 48% compared to last year.
48% in equities trading. Must have been a volatile but profitable market for them.
Absolutely. And fixed income markets, while not as explosive, still contributed strongly, with revenue up 8%. So really robust trading results across the board.
Okay, CIB also includes payments, right? Handling large corporate transactions.
Yes, and payments revenue saw a modest increase, up 2% year over year.
Only 2%, after those big trading numbers.
Okay. Well, it was 3% if you exclude some equity investment impacts. Growth there was driven by higher deposit balances from their commercial clients and fee growth. But like on the consumer side, they also mentioned feeling some deposit margin compression here too.
Ah, that margin compression again. Seems to be a theme across the bank.
It definitely is. A key factor in the current interest rate environment.
Okay, next segment. Asset and Wealth Management, AWM. Managing money for the wealthy and institutions. How did they fare?
AWM also had a very impressive quarter. Net income jumped 23% year over year to $1.6 billion.
23% growth in AWM income and revenue.
Revenue was up a strong 12%, hitting $5.7 billion.
So what's fueling that growth in asset and wealth management?
It really came down to higher management fees. And that was driven by two main things.
Okay.
First, really strong net inflows of client money. They pulled in $90 billion in new assets during the quarter.
$90 billion in net new money in just 3 months. That's huge.
It's substantial. Shows clients are confident in trusting their assets to JPM. And second, higher overall market levels boosted the value of the assets they already manage, which also increases fees.
Right, because fees are often a percentage of assets. So strong inflows plus rising markets is a great combination for them.
Exactly. As a result, their total assets under management, AUM, climbed to $4.1 trillion.
$4.1 trillion under management, just staggering numbers. Up 15% year over year, you said?
That's right, up 15%.
Okay, one more segment to touch on. Corporate. This one's usually a bit more behind the scenes, right? Treasury miscellaneous items.
It is. It includes things like the firm's treasury management, resolution planning costs, and sometimes one-off items. And there was a significant one-off this quarter.
Oh, yeah. What was that?
Their net income in corporate was way up, but largely because of a $588 million gain related to their acquisition of First Republic Bank last year.
Ah, the First Republic integration. So a one-time boost to the corporate bottom line.
Correct. It significantly skewed the year-over-year comparison for that segment's income.
Anything else notable in corporate?
Well, interestingly, their net interest income in corporate was actually down.
Down. Why was that?
They cited the impact of lower overall interest rates affecting their treasury results, and also some changes in how they allocate funding costs internally, particularly for consumer deposits.
So internal accounting and rate impacts hurt NII there.
Right. But on the other hand, their non-interest expense was down quite a bit.
Lower expenses. Why?
Because they were able to release an accrual they'd previously set aside for an FDIC special assessment charge. Since the final charge was lower, they could release the difference.
Okay, so corporate was really influenced by these sort of unique items this quarter? The First Republic gain and the FDIC assessment release?
Very much so. Less reflective of core ongoing trends compared to the other segments.
Right. Okay, so we've walked through the segments. Now, let's maybe zoom out again and compare some specific metrics against those analyst estimates from Zacks. We know revenue and EPS were beats, but what about other line items?
Sure. Let's see. Net loan charge-offs as a percentage of average loans. They came in reported at 0.7%.
0.7%. And the estimate?
Exactly. 0.7%. So right on the money there. No surprise on charge-off rates overall.
Okay. What about book value per share, a measure of the company's net worth?
Reported $119.24. The estimate was a bit lower, $117.88. So a slight beat there, slightly stronger book value than expected.
Good. And total interest earning assets, the size of their balance sheet, essentially.
The average balance was reported at $3,668 billion, roughly. The estimate was for $3,563 billion. So their earning asset base was actually larger than analysts' forecast.
Interesting. More assets earning interest than expected. What about asset quality beyond charge-offs, non-performing assets?
That was actually a positive surprise. Total non-performing assets loans, seriously delinquent or in default, came in at $9.11 billion.
Okay. And the estimate?
Analysts expected $9.81 billion. So fewer problem assets than anticipated. That's definitely a good sign.
Lower NPAs than expected. That is a positive signal on credit quality. Now let's drill back down into the segments versus estimates. We know CCB revenue overall was up 4%, but specific parts.
Yeah, within CCB, that strong card services and auto revenue we mentioned, $6.85 billion. Was well above the estimate of $6.32 billion.
So card auto really outperformed expectations. What about home lending?
Home lending was slightly below forecast, reported $1.21 billion versus an estimate of $1.23 billion, so a little softer there.
Almost exactly. $19.67 billion reported versus $19.66 billion estimated. Pretty much in line.
But within CIB, were there divergences? You mentioned payments earlier.
Yes. Payments revenue was a miss. $4.57 billion reported versus the $4.87 billion estimate.
Okay, payments missed. And consequently, the total banking and payments revenue within CIB also came in below expectations. $8.75 billion reported versus $9.39 billion estimated.
So the core banking and payments side of CIB was a bit weaker than forecast. What about the trading desks versus estimates?
Fixed income markets revenue was slightly below the estimate, $5.85 billion versus $5.9 billion expected.
Slight miss in fixed income. But equities, that was the huge growth area.
And it crushed estimates. Reported $3.81 billion in equity markets revenue against an estimate of only $3.17 billion. A really significant beat there.
Huge beat in equities, slight miss in fixed income. So overall market.
Overall markets and security services revenue within CIB beat expectations. $10.91 billion reported versus $10.27 billion estimated, largely thanks to that massive equities performance.
Got it. So a real mix when you dig into the segment details versus the analyst forecast. Some strong beats, some misses.
Definitely highlights the complexity. The headline numbers don't always tell the full story.
So true. And how did the stock market digest all this? The share price reaction.
Well, according to the Zacks article, JPM's stock price was actually up slightly, about 0.9% over the past month leading up to this report.
Up almost 1%. How does that compare to the broader market?
That's the interesting part. Over that same period, the S&P 500 index was actually down 6.1%.
Wow, so JPM outperformed the market quite significantly in that recent period.
Relatively speaking, yes. It showed some resilience. And currently, Zacks has a rank #3 on the stock, which is basically a hold rating.
A hold, meaning they expect it to perform sort of in line with the market going forward.
That's generally what a hold rating implies, yes. Not strong buy, not sell, just kind of neutral for the near term.
Okay. Now, we absolutely have to talk about Jamie Dimon's perspective. The CEO, his comments always get a ton of attention. What was his main message this quarter?
The big headline from him, repeated in the press release and echoing his recent shareholder letter, was his warning about considerable turbulence ahead for the economy.
Considerable turbulence. It sounds ominous. What specific factors did he point to?
It was a whole list, really. Geopolitical tensions, obviously,
Yeah.
but also potential positives like tax reform and deregulation balanced against potential negatives.
And the negatives were?
Things like tariffs and trade wars. He's been quite vocal about the risks there, plus sticky inflation, high government deficits, and still, in his view, elevated asset prices and potential for market volatility.
So a very complex picture with significant risks, even if there are some potential upsides. A generally cautious tone, then.
Very much a cautious tone regarding the macro outlook, despite the bank's strong Q1 numbers.
So given that caution, how is he saying they're positioning the bank?
He emphasized, again, their commitment to maintaining that fortress balance sheet, keeping excess capital, maintaining ample liquidity, basically preparing for potential storms.
Battening down the hatches, financially speaking.
You could put it that way, yeah. Prioritizing resilience.
But at the same time, they're still returning a lot of capital, right? The buybacks, the dividend increase we mentioned.
Absolutely. And that's the balance they're striking. He noted the share repurchases and the dividend increase. I think the dividend went up about 12% recently.
Right.
He said these actions are supported by their strong earnings and capital position. So it's caution, but also confidence in their own strength to reward shareholders.
Interesting balance. Okay. The earnings presentation also gave some specific financial outlook points for the rest of 2025. What did they guide towards?
For net interest income, NII, they projected around $94.5 billion for the full year.
$94.5 billion in NII.
But, and this is a big caveat, they stressed it's highly market dependent on rates, balance sheet size, etc.
Naturally.
They also gave a figure excluding their markets NII, projecting around $90 billion for that, again, market dependent.
Okay, what about credit losses for the rest of the year? We saw the reserve build in Q1.
They gave guidance specifically for the card services net charge-off rate. They expect it to be around 3.6% for the full year.
3.6%. So pretty close to the 3.58% we saw in Q1, maybe ticking up slightly.
Exactly. Suggests they see credit losses in cards staying around this level, maybe normalizing a bit higher.
And finally, expenses. Always a big focus. What's the outlook there?
Their forecast for adjusted expense is about $95 billion for the full year 2025.
$95 billion.
Again, market dependent. And importantly, that excludes any potential major firm-wide legal expenses that might pop up.
Right, those can be unpredictable. Okay, so that covers the releases, the presentation. Now for the analyst call transcript. This is where we get a bit more color, maybe some unguarded comments. What were the key discussion points?
Capital management was definitely a hot topic, as you'd expect, given those high CET1 ratios.
Right, they have all this capital.
And the CFO, Jeremy Barnum, actually called it a high-class dilemma, having so much capital building up.
A high-class dilemma. I like that. So what's the plan?
He stated their intention is to arrest its growth, Basically, stop the capital ratios from climbing much higher.
Arrest its growth. And how do they do that?
Well, the implication was pretty clear. If they don't find enough attractive ways to deploy that capital organically lending, investing in the business, then the alternative is returning more to shareholders.
Meaning more buybacks.
That seemed to be the strong suggestion, yes. Expect potentially larger share repurchases if organic growth opportunities don't absorb that capital build.
Okay, so leaning towards more buybacks potentially. What else did analysts push them on?
Investment spending came up quite a bit. Management really hammered home the point that they are continuing to invest heavily.
Investing in what?
Across the board, really. Key growth initiatives, technology upgrades that's always huge, and driving efficiencies throughout the bank. They see it as essential for the long term.
Makes sense. You have to keep investing. What about the regulatory environment? Always a minefield for big banks.
Yeah, both Barnum and Dimon touched on it. The main message was a desire for a, quote, coherent, rational regulatory framework.
Coherent and rational. Easier said than done, perhaps.
Perhaps. They stress needing a balance. Rules that ensure safety and soundness, obviously, but that don't stifle the bank's ability to support economic growth.
The perennial balancing act. Any specifics?
There was some discussion around the GSIB surcharge, that extra capital buffer required for globally systemic banks. Barnum expressed confidence they'd stay in their current 5% surcharge bucket, which impacts how much capital they ultimately need to hold.
Okay, staying in the 5% bucket. Good for them, I suppose. And finally, loan growth. Did they talk about demand for loans, given Dimon's cautious outlook?
Yes, and it was interesting. Despite some signs of improved business sentiment out there, they say they haven't really seen a significant pickup in loan demand yet.
Really? Even with the economy still growing, why not?
Barnum offered a few potential reasons. Larger companies can easily tap the capital markets, like issuing bonds instead of borrowing from banks.
Right, the bond market has been wide open.
Also, corporate balance sheets are generally pretty healthy, so maybe less need to borrow. And perhaps smaller businesses are still being cautious about taking on new debt, given the uncertain outlook.
So loan growth remains somewhat muted despite the strong economy on paper.
Seems to be the case, according to their observations on the call.
Okay, so pulling it all together,
Uh-huh.
it feels like the picture is really strong Q1 results, beating expectations, especially in CIB trading and AWM inflows.
Definitely. Strong execution in those areas.
But layered underneath is this persistent, cautious tone from Dimon about the macro environment, the turbulence.
Yes, that caution is unmistakable. And it's reflected in things like the credit reserve build.
And they're managing this by keeping that fortress balance sheet strong, investing strategically, but also signaling a willingness to return more capital, likely via buybacks if needed.
That sums it up pretty well. They're navigating this complex environment from a position of strength, but they're clearly preparing for potentially rougher waters ahead.
This deep dive, looking at the press release, the deck, the call, it really gives you, our listener, a much richer picture than just the headlines, doesn't it?
Absolutely. You see the drivers, the nuances, the management thinking. It's about understanding the why behind the numbers.
And for you listening, understanding a giant like JPMorgan Chase, their performance, their outlook, it really acts as a kind of barometer for the wider economy, doesn't it?
It really can. Their business touches almost every part of the economy, so their results and their leadership's commentary offer valuable clues about where things might be heading, both for finance and beyond.
So maybe here's the final thought to leave you with. You have Jamie Dimon warning about considerable turbulence, yet the bank just delivered these strong earnings and boosted shareholder returns. So what specific scenarios do you think JPMorgan Chase is actually preparing for behind the scenes? And what could those preparations signal, maybe subtly, about their real expectations for the broader economy over the next year or two?
Definitely something to think about. Thanks for joining us for this deep dive.